Wamda recently launched a grant-based fellowship program aimed at attracting promising entrepreneurs from across the MENA region to start a business.
It's a grant-based system where we bring in highly promising entrepreneurs or would-be entrepreneurs, and we give them the infrastructure and the platform necessary to really form their concept in a very friendly environment.
It's the 4-month program that's based in Dubai that looks to invest $16,000 grants per fellow, as well as a $9,000 in-kind support stipend that converts into equity if the fellow founds a business. We also retain the right to invest up to, or it could be more than $100,000 per business that emerges that we feel we want to continue to back through their growth stage and continue to finance through Wamda Capital.
Although the startup scene in the region is nascent, it has come a long way in terms of numbers as well as performance.
When we started in 2015, we saw about 300 companies. The year after we saw 700. The year after we saw 1,400. And this year we're set to see in excess of 2,500 companies. So that gives you a sense of the accelerating pace of the formation of startups, not just in the UAE, but in the region as a whole. I think the UAE and Dubai in particular act as a linchpin and a central node of the wider regional ecosystem. When I started looking at early stage opportunities, I think there was about $25 million just allocated across the region for startups. If you look at it today, it's very hard to figure out what that number is, but it can easily be in excess of $1 billion that's being deployed or being allocated towards innovation in the ecosystem, with Dubai anchored and the UAE anchored as the hub for this type of activity.
However, in a time where the region is just reviving from an economic downturn, which resulted in tightened budgets, increased cost-cutting, rising public debt, and political uncertainty, one would think that setting up and recruiting in startups might not be the best idea. Faris explains why now is in fact the best time.
Tech and entrepreneurship does well when the economy is doing well, because tech businesses are inherently a more efficient way of doing business. Tech also does well when the economy isn't doing so well because of the capital efficiencies of a tech business. So there is an inherent upside in backing tech regardless of the economic cycle. Now, when it comes to actually recruiting and hiring primo talent at these startups, there's no better time to build a business than when the economy is not at its best, because that means that salaries are lower, there's higher rate of unemployment from qualified talent, and oftentimes that talent are looking to diversify their backgrounds and perhaps look to work with an earlier stage business that's disrupting an incumbent industry or a business that they've been working on. So it's actually the contrary, where you find that building a business at this economic cycle and retaining and attracting talent in this economic cycle are more favorable, both economically and in terms of the pipeline of talent you're able to access.
But in spite of all of these impressive figures, venture capital's contribution to the region's GDP is among the lowest at the moment compared to the rest of the world. There still are a number of issues and challenges that need to be catered to.
There's still a lot more room for growth and a lot more need for capital to flow to these companies. As a percentage of regional GDP, venture capital is one of the lowest in the world as a percentage of regional GDP in the region. We think the more you accelerate that, there is a wider multiplier effect on the economy. I think there's a very famous, if I'm not mistaken, MIT study on the multiplier effect of startups. I think there's a 5 to 10x economic multiplier effect. For $1 spent, it drives $5 of growth in the underlying economy. So we're very excited to kind of drive capital into innovation ecosystems and into startups, such that we can help drive the economy forward as well.
We see fintech as the core infrastructure that needs evolution in the MENA region that would allow for the next wave of scale-ups to emerge. So just to throw in some statistics, We are the largest. We have the largest percent of underbanked in the world. We have the highest credit gap in the world. Predicted to be anywhere between $300 billion and $700 billion in the region, and that's financing that SMEs or individuals could receive or that should receive in order to grow and build businesses. Another reason for that is the regulatory hurdle is a steep one, and you oftentimes have to pass through certain regulatory requirements pre-launch, which is a big deterrent to a lot of prospective founders to establish business, but also financiers to invest in these businesses at the early stages. I think the biggest challenges you'll always find are cross-border mobility and operation. So yes, this is a 350 million person market, but they are scattered over 22 markets. You oftentimes have to do repeated legwork in each of those markets to operate in them. That's a significant barrier. Access to talent, regardless of economic cycle, regardless of anything else, is the primary problem any business anywhere in the world will face.